When people are a couple years older than you, they act like they're 12 decades older than you. You ever get that?
Back in the day.
I'm in
right?
my 40s, if anybody's wondering on the pod.
If you're not getting educated about local and national real estate market conditions, CPI data, news, affordability, all the industry trends, you could be doing yourself. Actually, you are doing yourself and your client base a disservice. This is the Knowledge Brokers podcast. I'm here with Byron Lazine and Lisa Chinatti. I'm Tom Toole, and we've got special guest Doug Edrington from Chattanooga. Doug, you've had like a top 10 team with Berkshire Hathaway forever. You've been the number one team in Chattanooga for ever since I've known you. And you're a good friend. Thanks for coming on. Excited to have you chiming in here on the pod today.
Thanks for having us. It's about time.
About time.
About time is right.
It is.
Our great friend and my new neighbor.
For sure. New neighbor. Very exciting for the Naples contingent of Knowledge Brokers. Lisa, we're going to have to buy a duplex down there or something. Or I don't know.
And it will share
Doug's
one. We'll
15th,
have a compound.
Doug's 15th home. He decided to move into Naples.
Well, I'm excited to have Doug on. We've known Doug for a long time, and we've got a lot of data to cover here, and I want to get his take on a lot of these things because he's in so many different markets. I think this is going to be very interesting, obviously based in Chattanooga. So we're going to talk about CPI data. Zillow also came out and said it would take an unrealistic mortgage rate decline to restore housing affordability, and Lisa is going to break down, as well as Byron and Doug. They got the chance to see Danielle Hale, the chief economist at Realtor.com, talk about what's going on with Gen Z, what first-time home buyers are doing when it comes to the average age of a first-time home buyer and their savings patterns. And we also saw cancellations for purchase contracts were canceled at a rate of 15%, according to some Redfin data in September. We'll break it all down. Let's start with the CPI data. So CPI just got released this morning. It's 10:11 Eastern time. We're filming this right now. The Consumer Price Index showed a 0.3% increase on the month, putting the annual inflation rate at 3%, lower than expected. And excluding food and energy, core CPI showed a 0.2% monthly gain, and the annual rate also at 3%, less than the forecasts. And this was released for the first time since the government shutdown. It looks like the CME Group is still predicting a 25 basis point cut at the Fed meeting next week. There's a 96.7% chance here. Good news, bad news. What's everyone's reaction on the CPI release? I'm glad they gave us some data, considering the government can't get their act together and even work right now.
And I think they said we might not get one next month, right? I think this was a kind of unpredicted, but next month not promised. But
they had to,
Byron, you go
They
first.
had to come back in. Well, no, they had to come back in and provide this update because of Social Security payments are calculated off of this cost of living, and that's due November 1st. So they essentially had to come back in to handle that work of the people. So these are obviously the CPIs produced by the Bureau of Labor Statistics, and it's more tracked by investors, Wall Street, obviously, than the Fed tracks it, but the Fed's more interested in PCE. I think what stands out to me, so inflation went up 3%, off of 2.9% for 12 months, ending in September, 3% versus 2.9% ending in August. Okay, so it went up a little bit, but it went up less than expected. And if we go down to shelter, which we really care about, shelter went up 3.6%, but it only went up 0.2% on the month, so that's an improvement. And so you're finally starting to see this lagging data show up. The way they calculate shelter is about 2 years old data. They don't want to use Danielle's data at Realtor.com, which shows 26 straight months of declining rents in this country. Nope, they want to wait for their old, outdated owner equivalent rent. So finally, though, now, as opposed to reflecting 2 years of these in real time, these rents going down, it's starting to trickle in and show up in CPI. So I think that'll actually keep, even with some of the tariff concerns, this will keep inflation, near this 3% or under number for the foreseeable future. I'm not concerned on runaway inflation because shelter is going to continue to improve these numbers, as we saw here in this report. And it's, to me, it was good. 10-year stayed under 4% off of this report. Stock market went up. We're recording this 10 a.m. Eastern time and on Friday. So as of right now, that's kind of what's happened, and we'll get a cut next week. This gives cover to the Fed. And, kind of a nothing burger, even though Jerome Powell is probably wishing and hoping he'd have the cover to do something insane, but he doesn't.
So Byron, let me ask you this: for the average Joe out there, I'm going to put myself in that bucket just for this conversation. What does all that mean? Is it summed up to the nothing burger? Because I heard movement of less, tenths of a point.
Mm-hmm.
Like,
Well,
what does it mean for the average Joe? Because I'm scratching my head here, saying like, what did that mean? And then you said nothing burger, so I had a little confidence that I'm in line with you.
Yeah, I mean, well, here's where the consumer is going to feel it on this report. You had an increase on retail. That's likely due to tariffs. So, a consumer going and shopping retail, seeing a little bit of a higher price there on a month-over-month basis. The Fed is looking to get that 3% number to 2%. Why? Because some guy in New Zealand said that was a bright idea decades ago. And so that's the metric that they use. You can't figure out why it's got to be 2%, but that's what so they're going to drive down to 2%. Prices are always going to go up forever. That's what inflation is. So if inflation is at 2% a year, if that's the target, that means prices are going up forever and always. It means prices are not going back to 2019 levels. They've printed all this money. We had 9% inflation. It got out of control because the Fed didn't want to believe there was inflation. They gaslit America into saying it was transitory. And then they've been on this fight to reduce inflation back down to that 2% number. But it's reflective of prices always going one direction, kind of like real estate prices, up and to the right. And, why is this number good? Not if it was higher or came in hot for this month without having the job data, that would be really concerning for what the Fed's going to do next week. If the Fed cuts next week and cuts into December, we could possibly see, obviously the overnight, that the Fed funds rate is an overnight borrowing rate, helps small businesses in that. But we should see this 30-year fixed rate mortgage, which we really care about here, start to come down. And that's going to open up the real estate market, which for 3 years, as we all know, has been a suppressed transactions. You open up the real estate market, you open up 17% of GDP, and it impacts a lot of businesses and a lot of families and helps a lot of people out. So I don't know, that's kind of my general overall theme there, but the everyday person is really seeing what prices in the stores are being impacted the most. And this report shows there's been some level of stability there in recent months.
Well, interest rates for mortgages, I don't know. We actually didn't have it in our show notes for today, and we didn't put it in as one of our topics, but I believe yesterday they hit their low for 2025. So what do you guys think? Was that pricing in data from today already, or do you guys think we might see mortgage rates drift slightly lower before close of business?
Yeah, that was where I was going to go, Lisa. So the average Joe comment. Let's talk about the average Joe realtor who doesn't follow this stuff, right? Or the average Joe agent, because I think that is, that is going to help you communicate with your clients using data. I don't, there's been these predictions the Fed's going to cut rates 2 more times. So I love looking at the CME group because they basically tell you what they think is going to happen. Looks like written 25 basis points next week, and then another 25 basis points at the December meeting. So I'm a believer. A lot of this is already priced into rates. I think Byron, you said it. The investors are smarter than the Fed. Danielle Hale is giving data that the Fed won't use that shows real tangible information. So I don't know that rates are going to go down much more. I mean, you might see those kind of like 2 or 3 day windows where you can get a really good number. But we're at 6.18 right now or something like that. I don't think it's going to go much lower than that between now and the end of the year.
I'm more concerned about Jerome Powell.
I knew you were going to say this.
Extinguishing the momentum next week, just as he did 6 weeks ago. So 6 weeks ago, we had very similar rates to today. It actually touched down to 6.13 at one point, I know we're right at the year-to-date low once again, just days before the meeting, as we were days before the last meeting. And then Jerome Powell came out. It was obvious he didn't have a plan. He wasn't certain about their next steps, and the momentum was lost. And we went back up to nearly 6.4, but in the 6.3s. And so I think a lot of where the rate goes next week depends on what Jerome Powell says in that presser. I think over the next week, you see a rate that stays low, in the low sixes. And this is where I think, especially right now in this Q4, buyers who are actively in the market should be taking advantage, because these windows of, low sixes, they've vanished pretty quickly over the last 3 years when they've come. We haven't broken 6% and gotten into that 5 handle, and that's where we want to get consistently. You've got 20% of outstanding mortgages right now that are over 6%. So if you get a mortgage rate available for new purchases in the 5s, that starts to open up this market. It gives Fannie Mae's projection of 10% existing home sales, a real chance of happening. But for buyers in this fourth quarter, when you have the highest peak of negotiating time, when you get the low sixes, do you really need to wait for 5.9, or should you take action now, not knowing what Jerome Powell is going to say next week? Doug, I mean, Chattanooga's price point is what? And then, so I would assume a lot of your customers are using, a mortgage. Do you guys do anything to take advantage of these windows when the rates are lower, or is it more just timeline of finding a home? And how do you guys think about it with your customers?
Well, our average price point here is about 350,000. And so we deal with what we call like payment buyers, right? Like the payment matters. It really absolutely matters. Probably does in your market too, I'm sure. And the thing that comes to mind for me, maybe a little off track of what you're talking about here, but like there's all these ads and all these advertisements from the big box lenders of like, we've got this great rate, we've got this great rate. And then the thing that we're facing often is that when a buyer presents an offer to a seller and they've got an approval letter from a big box lender, it creates fear in our market, because oftentimes these big box lenders, they may have the best rate, but can they actually get the loan to the closing table? And the whole local lender conversation, I think, is interesting because the relationships matter. It comes down to who can actually get to the closing table. What's the cost of losing the house over 1/10 of a point on rate, but the loan officer didn't have the interest or the education or the experience to get it to the closing table? I don't know about you, but it seems like a lot of loans right now, they're getting harder and harder from an underwriting perspective, unless you're just a typical easy, clean, single borrower, W-2 employee, your credit's good. That's an easy loan. That's a big box lender can handle that. But it seems like more and more the debt to incomes are getting wonky. There's a lot of co-borrowers, there's parents involved. There's a lot of explanation letters with the lenders of saying why, yes, I have this debt, but I haven't paid it because my parents have been involved, or my son or my daughter's been involved. Does this make sense what I'm saying?
Yeah.
I think they need a quality experience. And I think when they watch the news or they read the headlines of a rate as this, we just keep seeing, I don't want to say keep seeing, but often see borrowers get frustrated of the lending process being difficult, and then missing out on their dream home, or throwing in the towel because there wasn't a loan officer to help them through all that. So I think there's another level to this of, getting home sales creeping up again, is educating the buyer to understand that the loan officer is just as important as the agent, because it's not just a rate. You're not just like, I'll take that rate. It never works out that way. That's what's going through my head.
Well, and you look at, some of these trends we're going to talk about here. The average first-time home buyer in 2024 is 38 years old. Like, that is insane. And when you think about that, when it was 33 just 5 years ago. You look at what Gen Z is going through now. BAM just did an article about this where they talked about how, Gen Zs they're starting to save for a home right now, and it's been really important. Lisa, you got some Danielle Hale data that you're going to talk about how that shifted. And boomers control what, 1/8 of the world's wealth right now. I mean, they've got all this money, and these people that want to buy, it's wonky. You got. It's tougher to put these deals together for a lot of folks, and I think you really see that in the median and the average price points more so than when you get into the higher up numbers.
Totally. Should we segue into talking about data?
Go for it, Lisa. What do you got?
Thrive? Well, first, I want to acknowledge it was great seeing all three of you guys in Park City, Utah this week. Doug, you were a surprise guest. I didn't expect to see
All three
you
of
until I saw
you were
your
a
name
surprise to
tag.
me. Yeah, you guys were a surprise to me. That was fun.
Super fun.
I want to remind everybody that we signed NDAs before we arrived in Park City. Doug, did you sign yours?
I assume we all did. Yes.
Because if you didn't sign yours, then you could spill the beans on everything.
Thanks for the volunteer. The volunteer for me. That sounds great. Yeah.
But I think we can share the Danielle Hale stuff. Update for,
I mean, that's economic data. I don't think that's anything that
no, it's fine.
need to be NDA.
Damien said we could share the good stuff. You just said that was the not good stuff that we had to keep on the NDA.
No, I thought it was all good.
There's some stuff I'm pretty sure we shouldn't be talking about that I'd like to, but we're going to leave it there.
For the knowledge broker peeps out there that have been listening all along, you've heard Danielle Hale on this pod. She'll be back the end of the year. So around Thanksgiving time, she's going to produce the Realtor.com 2026 projections. And shortly after they release that, she'll be back on the pod to break it down with us. So that'll be exciting. But she had an update in Park City. Lisa, what were your notes on that?
Yeah. So, so first, always a wealth of information. And I think some of the big highlights for me were what we kind of just segued into, which is understanding how things are changing for Gen Z and what's shaking out with home ownership rates in particular generations, but then also where the average age of the first-time buyer is moving to. And I think one of you said it, 38 years old. Like, really stop and think about that. How old were each of you guys when you bought your first homes?
19.
23.
Same.
So I was the old one. I was 24 when we bought our first home. But could you imagine 38? Like, that would mean that, Byron, you would have just been buying your first home. Tom, you a couple of years ago. Doug,
I would have just been buying my first home when?
You're not that much older than 38. You're like...
He's 2 years older.
You're not that much older than me.
It's market. It's
when people are a couple of years older than you, they act like they're 12 decades older than you. You ever get that?
Back in the day.
I'm in my 40s, if anybody's wondering on the pod.
Although, I did have some culture
not
shock.
In her 50s, if anyone's wondering. Yeah. She may act like it.
I'm dressing up as Al Bundy for Halloween, and a lot of people in their 30s had no idea who that was, and I was like, man, that's disappointing. So there are some instances where that happens.
I'm in Denver right
Bridget
now.
Being Peggy?
Oh yeah, I sent you guys pics.
Bobby, how old are you? I'm turning 30. He's turning 30. I'm in Denver, and I said, "Oh, look, there's a restaurant, Elway's, in the Ritz," and he's like, "Well, what does that mean? Who's that?" I'm like, "We're in Denver, and there's a restaurant named Elway's. You don't know what I'm talking about here? John Elway?
Oh my
Super
goodness.
Yeah, crazy. All right, Lisa, go ahead. Sorry.
So anyway, I think some of the really interesting stuff there, and the other thing that I'm going to add is there was a lot of talk, and I think all four of us have to really acknowledge the effort that Danielle Hale has been making to help Realtor.com on their mission to be number one. And I think they gave her a really impressive shout out in Park City, which is she is the number one real estate economist in the world, right? And so that's super powerful. And I think all of our listeners, if you're not taking advantage of the information that she's putting out on the Realtor.com website, I think it's a miss because there's some really powerful stuff there.
Yeah, we use it all the time on the hot sheet. It's the best. It's great data.
I agree.
Yeah. And kind of like a sideways path from where I was going with this. She also kind of chatted a lot about, and I think Damien did as well, about what they're doing to bring that information super local in each thing. So as we were preparing for the show today, I sent in our group text that Byron, unfortunately, you were excluded from.
That's why I hate group texts.
You also said you weren't going to be on the show, so we were doing you a favor. because you hate group
Yeah.
text. So
But you could Google the average age of first-time buyers. So I Googled Realtor.com report average age of first-time buyers. And not only did it come up with the national stat, but there was a whole page about average age of first-time buyers in Massachusetts. And so I think that this is stuff that we should all be learning from as well, with what is the hyperlocal data that we all need to be thinking about and putting out in order to build our brands, to build authority, and how do we further our march to being number one in our own marketplaces? But that aside, my question, were you guys surprised? Average age of first-time buyers up to 38. Surprising? Shocking? Expected?
Doug, what did you
Already-
think? Because I mean,
already knew that
I'm
data.
curious what Doug thinks. Yeah, that's
Well, yeah, like average Joe over here. First off, Lisa, you're showing your age by saying you're Googling things still. But
ooh.
Yeah, exactly.
Right.
So I told
Googled
you
it.
she acts like she's 50.
right? Decades, eons ago, back in the day when we Googled.
Whoa. Okay,
Well,
Doug. I see you. I see you. It's all good.
what comes to mind for me is like, okay, is it a economics thing or is it a culture thing? Because I think there's in Chattanooga, Tennessee, I can't speak for the whole country here, but there are jobs. Like if you're willing to get out there and work, there are well-paying jobs. There's tons of money out there. People are trying to find. It's funny. It's like you have one side saying of people, right? One side of people saying I can't find a job, and then you have like every employer that I know saying I can't find people willing to work. And so like I think there's a big cultural situation here of are they willing to put the work in to be able to keep up with today's needs of it's going to be more expensive. So I mean I'm kind of not shocked that the average
Okay.
age is 38. I mean it is kind of weird to think about because of back in the day when we bought houses, but like at the same time though I'm not shocked because it's gotten so accustomed to just renting and having a free spirit and the ability to go wherever and not wanting to settle down early on. So it's not shocking to me. What not to shift gears too hard here, but she gave us all these reports, these local reports, which were really valuable for each of our markets. You guys got those as well, didn't you?
Yeah.
Talking about your local market and in Chattanooga, I think I've confused myself in thinking that so many people were coming from the West Coast, and I think maybe we're just capturing that market share because of our marketing efforts and our lead sources. But like I'm looking at this report right here for Chattanooga, Tennessee, the number one place people are moving from is Atlanta at 19%.
Wow.
But the runner up, which surprised me, was up near you guys. It was New York and New Jersey is 9%. And so a lot of people are moving from, down south. And I mean, it's not totally surprising, but I really thought that the West Coast side would be there. So this kind of blew my mind to see that yes, average age 38 shocks a lot of people. I'm looking at it through a slightly different filter, but then like where people are having to, I don't know if it's move to or run from because they can't keep up with the expense. I mean, it's expensive up where you guys live.
There's probably a little of both. I mean, I had a client I tried to refer to you, Doug. They moved to Chattanooga. I mean, that's the first time I've heard something like that.
Yeah.
But if you look at
that was the first from Philly area, right?
For sure. And if you look at, I mean, even Philadelphia, we actually, and Pennsylvania, our migration patterns are New Jersey because the taxes are higher, New York because the taxes are higher. We get a little California. So we're kind of seeing that on a different level because Pennsylvania is a little more of a tax-friendly state when it comes to income and property taxes. And there is some movement there. I mean, that started really during the pandemic. I mean, our buddy Byron here went all the way down south from Connecticut. So, I mean, that's, at least, are you seeing those same kind of movements from Boston and Massachusetts?
Yeah, we've got New Hampshire just above us to the north, which is a much more friendly tax state. And so when we look at the migration patterns from Massachusetts and then into New Hampshire, there's a really big flow right there. And interestingly, New Hampshire is getting a lot of migration from southern states and western states, which, Doug, to your point, that shocked me because I just don't think of anybody wanting to move into the cold weather. But apparently it's a draw, which is super interesting and fascinating.
These insights that Danielle provided for
Yeah.
all of us are really important to understand your feeder market, not by guessing, but by knowing. To everybody's point here, I just had a conversation with Michael Valdez, and we're going to release a podcast next week. He's the CEO of LPT International, and he's done it all. Sotheby's, formerly Realgy, now Anywhere, BXP, now LPT. I mean, he's done it all in the industry. And we got into this conversation about really understanding your feeder market, because then there are not only advertising approaches you can take and campaigns you can take, but tactical relationship moves that
Without
you
a
can
doubt.
make to capture that feeder market. And so that'll be up on the BAM channel next week. But if you don't know this data, it's hard to put yourself in position to capture any of it.
Byron, this is kind of interesting. I'm looking at this list of the top 10 markets where people are moving from to Chattanooga. This may be harder for some of you that live in the big cities, but in a mid-size or small city, I guess you could say, this entire list is where all of our direct flights go to. Like
There you
Atlanta,
go.
New York, Chicago. Like Chicago's number 3. I would have never thought of that, but I'm like, wait a minute. We have a direct flight to Chicago. We have a direct flight to Miami. We have a direct flight to Washington. Like all
That's
of
a
these.
great insight.
So maybe there's something to be said for these
I-
smaller mid-sized markets, like where your direct flights are coming from. That kind of makes a lot of sense. It's easy to get to and from.
I think that makes a lot of sense, especially if you're going to have if you're going to have 2 homes, which would just be a couple shy of how many Doug has. But if you have 2 homes and you're going to go back and forth between the 2 places, then yeah, you want to have direct flights between your 2 locations, and the chances of you having interest in a place to move to increases if you're visiting there frequently, and direct flights increase the chances. That's an interesting insight. I'd like to, maybe we can get Danielle to dig more into that and see if there's a correlation across all
I don't know if
markets.
it's just my market, probably not. But I'd be curious to know for the smaller markets that don't have flights to everywhere, if there's any correlation. Yeah.
Yeah,
I think it
well,
makes
it's
sense. I mean, didn't the Philadelphia flight just get added a couple years ago too? I mean, that's and you figure people from New Jersey, Doug, they
I think
fly to Philadelphia.
We lost the
Okay.
Philly flight in Chattanooga, I think, and it's not on the list, which is
Oh,
interesting.
interesting. Okay.
Doug, where you just bought a home in Naples, congratulations.
Thanks,
Historically, Southwest Florida has been really a Chicago kind of, hot spot for second homeowners. And then after COVID, you had more of the Northeast go to Southwest Florida, but Chicago's always had this direct flight. And so I'd love to get Danielle to dig into this. I think there's a correlation there that could be interesting.
Does the airlines control where people move?
It's a great question.
Yeah.
Well, you figure they're trying to make money, so if they are moving there, I mean, they probably study this as much as anybody else. Just like looking at lead conversion. I mean, it's the same thing.
Super fascinating. Super
Yeah,
fascinating.
years ago we got the Volkswagen plant, and after that they pulled flights from DC and from Chicago. Those were correlated completely together, and that was kind of interesting. I don't know if it's recruiting talent, if it's for lobbying up in DC, but yeah, interesting.
Lisa, what other thoughts from Danielle?
I think that those were the big ones. I think the tie-in, now BAM had just put out the article, 3 and 4 Gen Z adults are already saving for their home, because I think that they're feeling the pressure, right? I think that we're starting to see that those Gen Z folks recognize that, and Doug, I might slightly disagree. I think affordability is a big issue. And I think that this is something that we all kind of have to be aware of. And it ties into the conversations around interest rates. And so I'd love to kind of dig a little bit deeper. You said all these jobs available, average purchase price of $350,000. Do you know what the average income is down in Chattanooga? Like, is that average purchase price attainable?
I'd be lying if I told you I knew what it was. I'd take a guess. It's probably around 75,000.
Okay. Yeah, it would
If
just
it's
be interesting to
75,000, 350,000 would be attainable if that number matches up.
The median household income for Chattanooga is $62,547. So it's about 63.
62,000. Okay.
Yeah, and that's from city data. Now the average household income, because the median's bullshit, is 91,000.
Wow. Okay.
That was close. It was in the middle.
And what's the
Doug's
You're right
bumping up
there,
the
yeah.
average.
Yeah.
at 91,000? What's that affordable purchase price if you do the math on it?
What's the normal? The normal is 4x the annual income is kind of how people calculate what they can afford. That's a good rule of
So
thumb.
350 is
Yeah,
right
360.
there, right? Because so it would be
But
360.
but
So
and this may be cultural differences here. I'm in the South in Tennessee. There's a lot of two household incomes here. It's kind of popular to get married and have kids and put money together and file married and versus separate and so like I mean you're looking at $150,000 household incomes. That's not crazy. So
Well, that
Mhm.
average that Tom said was the household income, right?
yeah,
That
it's,
wasn't
it's
Yeah,
not
that's
single.
household.
per
Yeah,
person.
these are household. These are not per
90.
person.
oh, okay. I thought that was per person.
Yeah,
So
yeah.
90,
Yeah.
That's household.
90,000 average for a household is what you're saying.
Yeah.
Yep.
Right, which puts
Gotcha.
the affordability right at the cusp of your average of
Well, that makes sense.
350.
Yeah.
One of the other things I'll send the slide along afterwards. I shared it in our group text or I think I did, kind of chatting about where we're falling short in building homes and the biggest areas of price points where we need homes. And the biggest deficit is falling in the max price range of 254, 780,000. And so we're short 415,000 homes in listings right now. And so it was really interesting to kind of see where those numbers were falling.
Yeah,
Byron,
but
you were
think
going to
about
say
where we're
something?
short. $250,000 price point is where we're have this extreme shortage, and
Well, if
builders
you
carve a margin out of that. How? With
Yeah, they're
well,
not going to make any money.
Yeah, the three biggest pockets where we're short, and this is, I think, kind of tying into affordability when we talk about it across the board, was a max price of 169,850. You can't even buy a parking spot for that amount of money up here, and then it went to 339,700, and then this 254,
Th-
and so
this
go
is the
ahead.
problem. I listened to the live chat on Hot Sheet every single morning, and there are developments in rural parts of Texas or Oklahoma City where there's new construction at the $250,000 price point. You know what else there is in a lot of these markets? High inventory.
Mhm.
And
Right.
you know where you need $250,000 homes? Where you can't even, to Lisa's point, buy a parking spot for them. It's the Northeast where you have the lowest inventory.
Yep.
So the problem on inventory is much deeper than 4 million homes, as Danielle said to me, demand. It's that you can't build for the price points that are coupled with high regulations in the Northeast. The Northeast decision makers they make it really easy to complain about affordability, but really hard to solve the problem because most of these Northeast towns do not want it in their backyard. Even though they front like all they do is care about the little guy. They don't. They're liars.
Huh.
And then they have all these rules within these counties and towns to make it impossible for builders to put up the capital and take the risk in the Northeast. So nobody wants to build in the Northeast. The Northeast doesn't build. They complain that it's somehow everybody else's fault, but they're building in the South. Austin is the number one most affordable city in America. Why? Because they build and build and build. And so that excess inventory naturally puts downward pressure on prices, but not everybody's moving to the Sun Belt states. And so you have an inventory mismatch, and it's going to take a lot to convince these northern states to make smart decisions.
There was an interesting article on. Oh, go ahead, Doug.
No, I was just going to say, like, I'm just curious from the outside looking in here up in New York, if this Mamdani guy, if he jumps in, what's that going to do to New York?
Josh Rubin says the sun is going to go up in the one. Where does the sun come up? The east, and then he said
It rises
it'll
in the
also,
east and it's going to set in the west. Yeah.
it'll go down in the west. Listen, I think we talked about it last week on last week's pod. So, and Josh Rubin's obviously a friend of all of ours. Doug's really good friends with Josh, obviously. And, you know, I think one thing Josh said is he's right. Like, Mamdani's not going to get a lot of this stuff through Albany. That he wants some of these big grand ideas that are super unconventional and have a history of failing in other countries over decades of time. But yeah, prices probably go up. There's probably an uptick in migration out of New York. I benefit to both of those, Connecticut and Florida. So I say, bring it on, Mamdani. Bring on the insanity. It's just he's running on the thing that's interesting to a lot of people, and it fits into, Doug, what you were talking about, this cultural conversation that we have high affordability issues and everything's unaffordable. That's what he's running on. Problem is, a lot of his plans are going to not make things more affordable. They're just going to increase costs, and they're going to lose revenue. But this is you want to gain a movement, gain a momentum right now, especially politically. You hammer home the affordability issues. That's what he's doing, because, and it is, I mean, Lisa made the point, it is really a top concern for most young people.
Isn't it like
It was
250,000 units he wants to, new units for the rentals, I think, or just affordability, and then rent control at a new level?
Yeah, rent control is not the solution. I mean, you can dive into that pretty deep, but rent control will not solve the problem.
I mean, New York's just so unaffordable as it is. Like, I mean, that's like, it's very expensive to live there. So, Byron, you were talking about some of these home builder regulations, and there was an interview for the Beazer Homes CEO, Alan Merrill. He's it's the 23rd largest builder in the country. It was on Resi Club, and he basically said the same thing you did, that the housing affordability strain isn't just about interest rates, which probably isn't going to change. I think Zillow identified you have to go to 4.43% in another Resi Club article to make affordability happen, which I think we can all agree we're not seeing. It's about decades of underinvestment in infrastructure and an over-reliance on permit and impact fees that push costs onto new home buyers. And they're seeing that. He mentioned Northern California. He said it costs $140,000 before they even break ground, just in government fees. So, I mean, that's,
can't build a $250,000 house with that as the starting point, right?
And across the country, the range is like 60 to 70,000, and it used to be under about $10,000 a home. So, that's part of the other issue here is you've got these government controls, and and then he starts to go into some other tangents there. But that's really the problem. I mean, that's insane amount of money. Even a $300,000 home at $70,000, right? You're already into the margin. When my dad was doing new construction, the builder equation that most of the builders would use is that it's got to cost about 1/3 for the land, 1/3 for the build, and then the rest is going to be like how they how they make a profit. And it's just not. If it's not profitable, people aren't going to do it.
I mean, just take Connecticut, for example. Connecticut has about 3.7 million population. Every year for single-family condo units, Connecticut brings on about 2,000 units online. That's nothing, okay, into a $3.7 million population. 2,000 units, brand new units, that's like a weekend in Florida. But yet you have a lot of the local government in Connecticut, the state government, complaining about how things are so unaffordable. Yet Connecticut went 60-40 in the election. Connecticut's a very blue state, but it went 60 blue, 40% red. Yet Connecticut has no red representatives and hasn't for years in that state. So you have the same people making decisions year after year after year in this state, the state of Connecticut, complaining about how it's so unaffordable, keeping these high regulations on builders, and then wondering why nothing happens. Okay, so the states that are well behind on building, kind of have to look at themselves and who's making the decisions in these states.
I mean, there's a lot of gerrymandering that goes on to keep those people in office. I mean, Pennsylvania just redistricted the entire state because they had these court districts that looked like, election districts where like they're going through like 3 different counties. Like, I mean, and that's, I think, one of the reforms that needs to happen as well, because, you see like you said, you see the way they vote and then how the reps are, and it's drastically different.
All right. I got to go before I get canceled. I got to give this keynote here in Denver. Doug,
Thanks for having me.
thanks for coming on. You guys take it home.
See you for Thanksgiving.
All right.
Yeah, I'll see you 7:30 a.m. Thanksgiving at the Tiburon. Anybody want to join our golf match Thanksgiving morning? Come down to Naples.
You're going to get messages about that, Byron. So that was not smart, because there will be people that will
He's
ask.
already gone. He pieced out as quickly
Goodbye.
as. Yeah, exactly.
All right, so I'm curious about this last thing I wanted to talk about here. That we got the September numbers for home buying contracts that were canceled, and there was 53,000 purchase agreements nationwide. It was 15% of the homes that went under contract that got canceled. That's up from 13.6% last September. Are you guys seeing these high cancellations in your markets? What are you guys seeing? And then maybe we can talk about how folks can learn how to negotiate and keep these things together, because there's a lot of reasons that can happen. But I'm curious what you're seeing on your end.
You can take it first, Doug. Are you feeling it?
Like you were talking about termination rates, like fall through
Terms,
rates.
terms, cancels, same thing.
I think we got a lot of youth in the industry. I think we got a lot of new agents. I think that has a lot to do with it. And so with a lot of new agents, I mean, it's natural. It's part of the business. Like as a new agent gets in the business, they just don't have the experience to see some things that maybe, an experienced agent would see, or try to avoid some catastrophes, I guess you could say, or wasted money for the buyers. But then you throw in the desperate agent who is more focused on the deal. Like
commission.
They have been in the business for a long time, but they're not a part of a great team like what we have, or they're the ones that sell a couple deals a year. And so I think a lot of, they're focused, they got the commission breath, right? They're focused on the paycheck. So they're just trying to get it to the finish line. So it's more important now than ever for the clients out there to really interview agents and make sure they're getting an experienced agent or an experienced team that is going to guide those along. But I think a lot of it has to do with the industry. Because I remember like that 2008, 2012 market, and I know you guys do too, where it was a different level of fall through rates, because it was like there were so many houses on the market. Like during the inspection period, another house would pop up and be like, "Hey, let's pull out of this one because that one's cooler," right?
Yeah.
And so we're not seeing that. But I think a lot of it has to do with inexperience, and here's one other thing I think kind of interesting. I don't know about you guys in your market, but think comparing back from 2008, 2012 to today, home inspectors have figured out how to monetize their business and protect the client. But like back then, there wasn't even a license in Tennessee for home inspectors.
Really?
Wow. So we did have one.
I think that I could be wrong, but I want to say licensures for home inspectors, I think in Tennessee have been maybe 10, 12 years. And so the quality of the inspector has gotten higher. And then these inspection companies, just like we've done with our real estate teams, they're turning into teams, and then they got to figure out how to monetize their business. And so there's all these add-on inspections. And so it's good for the consumer, because the consumer is going to know everything about their house. But I think that also is a comparison to years ago to today. They're going to find more things. And so I don't know. That's kind of where my head goes to, of like termination rate. I think it's lack of experience, but then also cultivation of the inspection industry. I think lending is doing pretty well at not having a lot of deals fall apart, in my experience, because a lot of the lenders that just threw out approval letters, I think they're not in the industry as much anymore. And so they're actually making sure they don't disappoint the client or the realtor. But I don't know. There's a couple different views of insight there on that.
One of the
to give
things
some perspective, hold on, Lisa. So 70% of the deals fell through during the inspection period. So that's the number that they had there. Just to be, so I think Doug, you're right on there. Go ahead, Lisa. I just wanted to put that stat out there.
Yeah, well, that's an even bigger tie-in. So, excuse me. One of the things we haven't talked about on the pod October 15th. Do you guys know what went into effect in
Oh yeah, this is crazy.
Massachusetts?
You got to hear this, Doug.
Oh,
Yeah.
is it, you're required to have an inspection, or is there something like that?
It's something, you're not required to have the inspection, but the buyer is not allowed to waive the right to a home inspection in the offer, and the seller is not allowed to accept an offer based on a waived home inspection.
That became law.
And it became law and in effect on October 15th. So we just kind of started navigating it just over a week ago, and it was crazy. Because the contracts that were written on October 14th, we could literally use our old paperwork. The buyer could waive the inspection. We could move forward. And then on October 15th, we had all new paperwork. We had new disclosures on both the buy side and the sell side. And you can't waive it. And if an offer came over with a waived home inspection, we had a couple of these shake out, we had to reject the offer outright and
Wow.
negotiate with some of the other offers that are in there.
I'm not a fan of that because it kills.
I'm not
capitalism.
either.
It kills capitalism. It's like, okay,
Well,
you should
what
be
if-
able
what
to
if
take
you're-
higher risk for higher reward.
What if your dad owns a construction company, right? Like they can go in. What if they're going to demo the place and they don't really care? I mean, there's other variables there than just waive it to get it. And I don't think that. I think that's probably what's missing on the law here. I agree with you fundamentally, Doug, for that. But it's not always, hey, we're doing this to get the house. Like that. That's the reality of this.
Yeah, and there was just because they can't waive it doesn't mean that they have to do it. And they're just like anything.
What's the
There's
loophole?
loopholes,
What's the workaround?
right? Yeah. So, I mean, the way that the new contracts are written, it's such that the buyer is taking the full contingency, which is, what it is, and like it was before. And then there's another line in there. So here's kind of super fascinating. We've had our first one under this, where the second option in this new law is that the buyer will conduct the inspection and will not break the contract unless the cumulative repairs exceed a certain value. Now, that value can be anything from $1 up until the entire value of the home, which is essentially kind of not waiving, right? But it's making that deposit non-refundable. And so what's kind of shaking out now is that we've kept our first deposit or a seller kept the first deposit after conducting a home inspection, putting in that they wouldn't use that contingency unless the cumulative amount of repairs exceeded $20,000. But what happened is, so they had that there, they did the home inspection, and they found something that they felt they couldn't live with. Now, what it was, I don't know. I'm going to assume something like a mold or radon or something like that, where the cost to mitigate was actually well beneath the threshold of $20,000, but then caused them to breach the contract. And now, under the old contract, that buyer would have gotten their deposit back, which is super fascinating. So that's one loophole. The other is just making the deposits quite large and saying to the buyer.
So Lisa, 1 second, I'm just curious. So you're saying the law was put in place to protect the buyer, but in this case, the buyer lost.
Yes, and I was a pretty big advocate for, well, I understood what we were trying to accomplish. The way that we're doing it is actually putting buyers at bigger risk to lose more money, right? So
what's the negotiation strategy there besides the money? Is it also time frame? Is there a limit on, like, are people saying I'll do a 1-day inspection?
Yep. Yeah, that's some of the other stuff. And so it doesn't really accomplish what we want. And it's going to create, just like in a lot of other things that have shaken out, it's going to create this divide with, are you working with an agent who's super skilled, who knows how to navigate these situations, who knows the paperwork, who knows the ins and outs? Or do you work with that agent who isn't, that up to date on it? And so we're going to see an even bigger divide shaking out with, representation. Wrong law. That's all I'll say. Wrong law.
Yeah. Well, and I think that you hit on something really important there, Lisa. And Doug, I'm curious to get your take on this. You said there's a lot of youth in the industry, which I do agree with. I mean, you look at the numbers, 87% of agents turn over in 5 years. 5 years ago was COVID, so this stuff didn't exist. Do you, how often, and I'm curious what you guys do in your organization, how often are you coaching and educating people on the contract? Like, hey, read through the agreement of sale, understand what this says, because invariably when there's an issue, what I find with co-op agents, with other agents, they don't even know what the contract says to do next. And I think this is a major problem within the industry. They rely on fill in the blanks. They think it's going to be easy. And that's where you can lose a deposit. You can lose a property. I mean, these are life-changing decisions and big money decisions here. How important is that for the people listening to know exactly what goes on with these? I mean, because I know the boards will usually offer like classes when these changes happen. At least ours do. I'm curious what you're doing and what maybe Massachusetts did here, Lisa, in this situation.
Well, I want to clarify. When I say youth, I mean like time in the business, not necessarily.
Yeah, I'm agreeing with you there. Yeah, low.
Because there's a lot of people at any age getting in the business. It's really time of experience, I guess, is probably the better term versus youth.
Mm-hmm.
But the way we operate is like I learned a long time ago. 15 years ago when we were starting to grow a team. The first thing we used to train these agents on is how to set an appointment. And then I learned very quickly, oh my God, they set an appointment and the buyer wants to write an offer and my agent doesn't know how to write an offer. And so we made a big change about 15 years ago that you got to do the technical stuff first. So like literally day one of onboarding for us, we put them through 4 weeks of certifications, and the first certification is contracts, and then they're quizzed, and then there's a final exam at the end of the month, and then the contract training never stops. It's weekly because I know you guys see it too. I mean, at least once a month, there is a new scenario that I have not crossed. Yep. And that's, we're pushing 6,000 sales and you'd think we've seen it all. And I know you guys are in those same kind of numbers. Like it's wild. So we've got to bring these, call it case studies, to our organization every single week and say, okay, we run across a new scenario. Here's what we thought. And here's probably what you would have thought. And here's what legal told us. And here's how it actually shook out. Because those three things can always be different. So yeah, it's super important. There's nothing worse than receiving an offer on one of your listings. And the reason you have to counter is to clean up the contract. But that happens more times than not. It's like, hey, this is an acceptable deal in theory, but the other agent didn't know how to write this properly. So now we have to counter the deal. And oftentimes, you guys probably still see some multiple offer situations.
Oh yeah, for sure.
On really good properties, right? These poor buyers out there that are represented by the uneducated agent, they're losing the deal because it's like, ooh, can they get it to the finish line? They wrote this offer so sloppy. We've advised our sellers before to take maybe a slightly less net because we think it's going to come together. They're like, hey, this one's likely to close. This one, his contract's written like a mess. We've done our research on the agent. We've seen how many sales they've done. It's not a lot. They're working with a lender that doesn't appear to have any relationship with anybody it was probably picked based on rate. So now it's like, okay, there's not a team on the other side that is educated here. This is just a random group of people that have aligned for random reasons. And here we are. You want to roll the dice on that one.
And I think, to your point, I think we see that with younger tenure, but I'm going to put it out there. I think we also see it with really long tenure, where they've stopped thinking that they can still learn more, right? Where they just think it's on autopilot, it's smooth sailing. And I think particularly over the past 18 months, where so much has changed, not just in the market, but in the industry, that there's a big divide. I think that there's this really sweet spot. And the interesting thing is it's shaking out in the middle.
Mm-hmm. Hey, here's a fun one. What do you guys do when you receive an offer today? And the agent obviously hasn't done anything in the last, 13, 14 months? What was that, August of last year?
Yep.
Mm-hmm.
And they didn't ask for any compensation. And you're looking at this deal saying, this agent's not going to get paid. How do you handle that? How do you handle it now?
So I've run into a couple of these scenarios. And
really? I've only had one.
Oh, we had one last week. And it's just like, have you been under a rock?
Well, is it written? Is there a spot in your contract where the agent has to fill it in? Mm-mm. See, all of ours have that. All of ours have a spot where it literally says compensation, and the buying agents have to fill in something. Otherwise, it looks like
the state's part to guide the agent. We still in Tennessee and Georgia, in both states that we're licensed in, we've got to. It's like special steps.
Yeah,
wow.
we usually have it in there. we've also run into the problem, and Lisa, I'd be curious because where people, they don't know how to fill out the contract and they're asking for like extra, like, so maybe the seller's offering something, maybe they're not. If the seller's offering it, they fill out the form where it says in addition to, and it's like, well, you're asking for, double or triple or whatever the number's going to be, or however many bananas. We've had to have some hard conversations with people, and then broker owners start getting on the phone, or brokers, and they're like, you don't know what you're talking about. I'm like, why don't you call the PAR legal hotline? And that's been a really good defense. I don't know if you guys have a legal hotline in your states.
We do.
It's a great resource to use, because instead of you getting into an argument with somebody, hey, I talked to the PAR legal hotline and here's what they're telling me. And it kind of eliminates that, because it becomes a pissing contest, Doug, where they're like, hey, well, we're right about this, or you guys don't know what you're doing. And nobody knows what they're doing, right? Like, it's been like, none of these people are attorneys. And if they are, they're failed attorneys practicing real estate. So it becomes such a problem. And there's a form here called the CBC form. And it says right at the top, this cannot be used as an addendum. It's a cooperating broker compensation form. Mm-hmm. And they're attaching it as an addendum. We're like, you can't do this. Like it says right here, don't attach this. And everyone gets so worked up. And what agents don't realize, like you said, Doug, that costs you the sale sometimes, because you didn't take 20 minutes to read the paperwork. And it's such a problem. And a lot of brokerages, they don't train their people on this. Like, we have offer review. I know, Lisa, you do this as well, where the first few contracts, until someone's competent, we have to sign off on them, because we don't want this to happen to our people. And so many brokerages do not train on the paperwork, or they give they don't do the, like, there's different levels of this, right? This is the inspection. They don't have them actually go through and write like a test offer, especially with some of the youth in the industry. And then there's the other people that have been doing it 30 years and don't know how to write a contract. And that's a whole nother problem. So it's all very fascinating.
We got 10-year agents, and they're still required to go through our doc review process.
Yeah.
Like, it's a legality issue, and it's a reputational issue. You got
just getting the deal done for your customer, right? Like,
and that's what I mean by the reputational piece. Like, you can't, and the legal piece.
Well, that's real support, though, and I think that's what people get misguided on, is that this is like, it may sound like a lot, but you screw up a contract, it can hurt a lot of people, and it can cost you a lot of money. And then these are legal documents, and agents are way too cavalier with them.
Slow down to speed up.
Hell yeah.
All right, I think we're at an hour, my friends.
Yeah, I gotta go. Doug,
thanks for having me, guys.
Great having you on. Where can people connect with you? What's the best
fun.
way to connect? Instagram, YouTube?
Yeah, Instagram. Doug Edrington. That's I'm a pretty unique name here, so there's not many of me out there. If you find a Doug Edrington, it's likely me. So, right. Facebook, Instagram, reach out. Love to connect. Chattanooga, North Georgia.
Number one team in Chattanooga.
That's right. And next time I'll make sure to get the note on having a mic. I wasn't as cool as you guys, so need the cool fuzzy mic.
Byron would have thrown us off the show if we didn't have these. So, all right. We'll catch you guys next week. See ya.
You've got a CRM for leads. Great. Don't want that to go away. But what about your clients? Most agents drop the ball after the deal. That's why they're called past clients. There's real money is in the referrals, the repeat business, staying top of mind for a year, making past clients actual clients. If your follow-up is just random check-in or a happy home anniversary, you're invisible. That's why my team uses Mosaic, and that's why the Mosaic team just made it available to all BAMX members at no additional monthly cost. Mosaic is a high-touch client experience platform. It picks up where your CRM leaves off, personalized property search, offer comparisons, real-time transaction timelines, automated homeowner reminders, equity updates long after the closing. This means your clients feel supported with you without duct taping 5 different systems together. And here's what makes this deal insane. Mosaic is normally $150 to $250 a month, but BAMX members, you get full access included in your $97 a month membership. If you're doing the math, that's like us paying you $150 every month just to stay ahead of your clients, just to keep your clients. Spots are limited by market for Mosaic. Some are already full. So if you're in a competitive area, go claim your seat now. Go to school.com/BAMX or hit the link.